Taxes are just frustrating. You probably feel like you contribute a lot of your hard-earned money to the federal government and have not gained much out of it. Let me show you some ways that you can do legally to avoid taxes and give you the full breakdown of how they can help you save taxes every year. These 5 methods are not complicated at all. In fact, it's just so easy a caveman can do it. Remember those Geico commercials? Nobody? Okay. All right. Tough crowd. Let me first show you how the US tax system works. You'd be surprised to know how many people actually don't know how your income is taxed. If you already know how it works, feel free to skip to the next chapter of this video. In the meantime, don't forget to download all of my financial resources for absolutely free by visiting firesightshare.com/resources. So let's first go over single or unmarried individuals and how they're taxed. And every US person who is employed full-time or part-time, the first 11,600 is going to be taxed at 10% for the year 2024. And keep in mind that the numbers I'm giving you are from 2024, depending on when you're watching this video. And your income up to 47,150 is taxed at 12%. And keep in mind that that is between 11,600 and $47,150, and not the whole $47,000. That makes sense so far, right? And if you make under $100,000, a portion of your income is going to be taxed at 22%, and 24% when you get above $100,000, but no more than $191,000. 32% if your income is less than $243,000. 35% if your income is less than $609,000, and 37% if your income is more than $609,000. Congrats if you're there. You made it. Most people are under the 24% tax threshold, but let me know in the comment section down below if you're in the 30% marginal tax threshold. And if you're married and filing taxes jointly, you're going to save a lot more taxes than single individuals. And I'm not by any means encouraging you to get married, but it's just the fact that you'll save more in taxes this way, because the first $23,000 is taxed at 10%, which is double of single individuals. And up to $94,000 is taxed at 12%. And up to $201,000 is taxed at 22%. Most married couples are between 12 and 22%. And if you're making over $201,000, but less than $384,000, you're going to be in the 24% marginal tax rate. And if you're making over $384,000, but less than $487,000, you're going to be in the 32% marginal tax rate. This will put you in the top 5% of income earners in the United States. And if you're making over $487,000, it's going to put you in the 35% marginal tax rate. And if you're making over $731,000 as a married couple, it's going to put you in the top tax bracket at 37%. And if you're a head of household, be sure to check out the different tax brackets on the IRS website. While the numbers are different for single and married, the concept of the progressive tax system remains the same. Okay, that was the quick lesson of the US income tax systems. Pretty easy, right? Let's say you're single, age 35, and make $120,000 a year. And before you complain about it in the comment section, I fully understand that this is not the median income of $70,000 in the US. And I'm using this example to show more marginal tax rates. You could be someone with a working spouse, and that would apply in this scenario as well. But anyway, the first method is using your traditional 401k, 403b, or TSP to reduce your taxable income. The contribution limit for those under the age of 50 is $23,000 in the year 2024. And these are the tax brackets I showed you earlier in the tutorial. This person is going to be taxed at 10%, 12%, 22%, and then 24%. And since they're making $120,000 in taxable income, the marginal tax rate will remain at 24% as long as this individual, his income or her income, does not exceed $192,000. So remember that only $19,000 of this person's income is taxed at 24%, not the entire income at $120,000. But anyway, if this person contributes the maximum 401k limit of $23,000, they could save $19,475 out of $23,000 in 401k contribution in the 24% marginal tax rate, which means that they can save $4,674 from the IRS right back into your pocket. The remaining $3,500 right here, will be just taxed at 22% because that's from the 22% marginal tax rate. So the total tax saving for someone making $120,000 a year in adjusted gross income after the standard deduction and contributing $23,000 in a traditional 401k, 403b, or TSP is a total of $5,450. Not only can you save taxes now, but you can also grow your 401k investments tax deferred until you retire. Just remember that you will have to pay taxes on the 401k, 403b, or TSP investments when you retire at the age of 55 or later. And let me give you one more example for those of you who are married. So let's say you are married and you're age 50 and make $150,000 in adjusted gross income. So that would be the household income. The contribution limit is not just $23,000, but there's also a catch-up contribution of $7,500. So people over the age of 50 can contribute up to $30,500 in the year 2024. And here's the same thing I showed you earlier. A married couple's tax brackets are at 10, 12, and 22% respectively. Because their income is less than $201,000, only a portion of their income is taxed at 22%, or $55,700. So with $30,500, this couple could save 22% from here, right, of the 401k, 403b, or TSP contributions, or $6,710 back into their pocket. What does this really mean? If they get paid bi-weekly and max out their 401k every 2 weeks, that's about $1,175 in 2024, every paycheck to the 401k, right? But because of the 22% savings from their marginal tax rate, they only end up contributing $916 in net savings to their 401k because they're saving $260 every 2 weeks on their paychecks by lowering their tax bracket. That makes sense so far, right? If not, you can always schedule your first session with me by visiting firesession.com/coaching. And the second way to reduce your taxable income is by contributing to the HSA or health savings account. And keep in mind that you have to be enrolled in a high deductible health plan in order for you to be eligible to contribute and invest in an HSA. And I have a complete tutorial of the HSA on my channel, so be sure to check it out after watching this video. But anyway, the contribution limit for single individuals for 2024 is $4,150, and the family limit is $8,300. If you're over the age of 55, that's an additional $1,000 to the HSA. So for single individuals under the age of 55 could save as much as $1,535 if you're in the top tax bracket. And this will obviously depend on your tax bracket, right? But most people are in the 22 or 24% right here. So that's probably how much you're going to save. But that's almost $1,000 in taxes if you contribute the entire $4,150 to your HSA. On top of that, you can invest in stocks, ETFs, or mutual funds inside the HSA. Did you know that? And if you're on the family HSA plan and you're over the age of 55, contributing $9,300 to your HSA, so $8,300 plus $1,000, right? And that could save you over $2,000 in taxes, in total taxes, if you're in the 22% marginal tax rate. You could save up to $2,200 if you're in the 24% marginal tax rate. And if you're a badass in the 37% marginal tax rate, that's $3,400 that you could save. And if you use my financial independence checklist from my resources website, I'm always prioritizing the 401k only up to the employer match. And then the next one I max out is the HSA because of that. Then after that is Roth IRA, but HSA is more important than Roth IRA because you get to make the pre-tax contributions and save you money on taxes. The HSA doesn't just allow you to save taxes now, but you can let it grow tax-free and will withdraw it tax-free for qualified medical expenses. And if you're truly investing for your early retirement, you should prioritize your HSA before the Roth IRA because of the quadruple tax advantages. And another way to save your taxes now is by contributing to the FSA or flexible spending account. And keep in mind that this is not the same as the HSA. And the first one is the healthcare FSA. And people use the healthcare FSA to pay for deductibles, copays, prescription medications, and over the counter medicines, Advil, anything like that. This FSA, though, is not compatible with the HSA, which means that you cannot contribute to both healthcare FSA and HSA in the same year. For the year 2024, each individual can contribute up to $3,200 or another $3,200 if you and your spouse are both working, and if both employers covered FSA for their employees. There's a carryover limit of $640 from 2024 to 2025. What that means is that if you have a balance of $641, that $1 cannot be rolled over to 2025. In fact, that $1 goes right back to the employer. So, unless you like giving your employer free money, make sure to keep track of how much you have in your FSA before the end of the calendar year. And the next one, it's what's called a limited purpose FSA. The account is actually compatible with an HSA because it's only used for vision and dental expenses. The contribution and the carryover limits are the same at $3,200 and the carryover limit at $640. So if you contribute $4,150 to your HSA and another $3,200 to the limited purpose FSA, your total taxable income could be reduced by $7,350. You could save as much as $14,700 if you have the family HSA plan and both you and your spouse's employers have the limited purpose FSA. With the marginal tax rate of 22%, you could save as much as $3,200 in taxes and it goes right back into your pocket. How awesome would that be, right? But remember, and I want to emphasize this, limited purpose FSA is for dental and vision only, okay? If you have healthcare FSA right here on the left, you cannot contribute to both healthcare FSA and HSA in the same year, all right? And the next one is what's called dependent care FSA. And not every employer offers this, but I've been using this one for a while. But I know that federal government employees actually get this benefit. So check with your HR department to find out if you have this benefit. And if you have kids under the age of 13, this dependent care FSA could reduce your taxes and pay for your child's after school program, day camp, nanny, preschool, and even the payroll taxes related to eligible care. For 2024, each household, that's the household, can contribute up to $5,000 to the dependent care FSA or $2,500 if you're your taxes separately from your spouse. Think of it this way. If it costs you $100 to pay for an after-school program and your marginal tax rate is at 24%, that's going to save you $24 for every $100 you pay for your childcare. And once you figure it out, it is extremely easy to use. And if you're someone working in a nonprofit organization like a public school, university, ministry, hospital, or charity, your employer should have what's called a 403B, which is equivalent to the 401k. So remember, a 403B or 401k is what's also known as a defined contribution plan. And these organizations also come with what's called a defined benefit plan or the pension plan. Some pension plans don't allow their employees to contribute to their pension plan at all, but only the employers can make all of the contributions. However, some employers allow their employees to make contributions to their pension plans, which will reduce their taxable income. So for example, if your employer's pension plan has you contribute 15% of your income to the pension plan, that's 15% of your income that is not going to be taxable, but you will pay taxes on the pension distribution when you retire. And some organizations will even allow you to have both 403B and 457 plan. A 457 plan right here, these two, right? They're what's also known as a deferred compensation plan. And it's very common for state and local government employees like police officers, firefighters, first responders, and tax exempt organizations. You don't have to be a firefighter to have those. You just have to be a state or local government employee and some charitable organizations. But you don't get charged a 10% penalty from the 457 plan as soon as you retire. So as soon as those state and local government employees retire, they can immediately start using the 457 plan to supplement their pension income. And some of these employees can also max out both 403B and 457 plans in the same year. So instead of just $23,000 for 403b, they could contribute another $23,000 to the 457. And your taxable income could be reduced by as much as $46,000 a year. This is really beneficial if you're a high income earner and one of your spouses happens to work in a nonprofit organization or state or local government. And if you're a federal government employee, the first pension you contribute every paycheck is actually in after-tax dollars. PERS is different because that's the state pension fund. You typically contribute to your PERS in pre-tax dollars, but FERS is in after-tax dollars. You still get taxed on the first annuity when you retire from the federal government because you're gonna get more than what you contributed. Some of your first pension is not taxable because you put your money in there in after-tax dollars. So you're going to recoup your contributions a little bit at a time during your life expectancy when you're retired. So when you get a Form 1099-R from the OPM, they're going to tell you exactly how much of your pension is taxed and how much of your pension is not taxed. How does this benefit you now? Not much. I just wanted to bring it up really quick because a lot of people I've talked to in the past thought that first pension contribution was pre-tax when it was really after-tax. But you can still use your TSP to reduce your taxable income. And I have a complete tutorial of the TSP on my channel, so be sure to check it out after watching this video. And here's some additional tax savings you can do while you're actively employed. First, I want you to find out if your state will allow you to deduct your income tax by contributing to a 529 college savings plan. And I know a 529, to many of you think that it's only for kids, but it's not. You can set up a 529 for yourself to fund higher education expenses now or in the future. So if you're someone who's working on taking your education to another level by going to a graduate school or trade school to work towards a degree or advanced certificates, you can use a 529 plan to pay for your education expenses and reduce your state income tax liabilities. And keep in mind that a 529 is a state plan, so you cannot deduct your federal income tax. And second, if you have a taxable brokerage account or some type of non-retirement account, you can use the tax loss harvesting strategy to reduce your taxable income by $3,000 in net losses annually. Just keep in mind that the wash sale rule does apply. So you can't sell a stock at a loss and buy the same stock or a similar stock within 30 days in a 61-day window. I'm going to use Tesla for example. Let's say you're down 20% on a Tesla stock and you sell it and then you buy a Ford stock. That is a similar stock, right? And so if you're going to reduce your federal income tax, you'll have to use the short-term capital gains or capital losses to offset your income. So you need to be able to segregate the losses between long-term and short-term capital gains. If you have more than $3,000 in losses in a year, you can carry that over to the following year, but the $3,000 maximum still applies. And speaking of offsetting your capital gains, you should find out from your broker if they have a donor advice fund or DAF to donate your shares to support charitable organizations. If you talk to big firms like Fidelity or Schwab, they will have DAF with the brokers where you can donate some of your cash or securities inside your brokerage accounts. And why is this popular? Well, if you're selling a stock with a significant profit, you could use the DAF to lower your capital gains tax and estate taxes. And this is not for everyone depending on your income and tax situation. So be sure to talk to your broker or CPA to find out if DAF is right for you. And the last one here is starting a home business. You will typically have two types of expenses to write off if you have a home business: direct expenses and indirect expenses. Direct expenses will be like this Sony FX30 I'm using for my YouTube videos right now because I'm using it directly for my business, right? Indirect expenses will be like mortgage interest, insurance, utilities, or internet you use in your home office to keep your home office running. And only a certain percentage of those expenses will be deducted from your business, but don't start a business just to write off your expenses. You want your business to eventually become profitable, right? You don't want to fraud the IRS if you're just doing this to write off your expenses and nothing else. And I get it. Taxes are frustrating, and I get it. I want you to take the time to watch this video again whenever you need it. And I will make sure to leave the chapters in this video so you can always navigate within the video. You may not have access to your HSA right now, but it doesn't hurt to ask your HR to find out if the high deductible health plan is available to you. If you have both traditional 401k and Roth 401k, I want you to do some serious comparisons to figure out which one may be right for you. I did several detailed videos on how to choose traditional versus Roth 401k, 403b, or TSP. So check those videos out when you get a chance. You can also download my retirement calculator, HSA calculator, and other financial resources for absolutely free by visiting firesuch.com/resources. And this has been another piece of the video, and I hope you got a lot out of it.